Quarter number 3 is going to be our test market quarter. Basically, you're preparing your firm to go to a test market. The goal for quarter number 3 is not to maximize your profits. There will be no profits for quarter 3. The goal for quarter number 3 is to maximize your learning in regard to what customers want and what they actually accept in your design. You need to set your selling prices. You need to develop an advertising campaign where you develop where you develop 2 ads, one for each brand, because you're developing 2 brands. Determine the number of placements per ad, and start executing your distribution strategy. You need to hire a sales force. You select marketing web tactics, and you expand your sales channel for quarter 4. In addition to that, you need to establish compensation packages for your employees. That includes what kind of salary, what kind of health benefits, what kind of vacation time, and what kind of pension contribution to provide for your employees. Of course, you probably understand that all these decisions have an impact on your cost structure for your products. However, employee motivation and its productivity is determined by how well the benefits offered by your firm match your employees' needs. So there is a cost benefit and a trade-off analysis that has to be done. You will also find out how competitive your packages is compared to the industry norm. And that means what other firms are doing. It will have an impact on your productivity. Next, you have to schedule production. You first have to forecast demand, set minimums and maximums for your warehouse, schedule operating capacity, and you must run a factory simulation to check your numbers. It is not surprising that your numbers in the first attempt might not work out, and that you will have to change these determinants. Therefore, make sure you run the factory simulation to understand how you optimize your production. As in quarters before, you need a contract for market research, in this case on customers and competition. And before you submit anything, make sure you check your pro forma financial statements. Let's talk about the market. In the simulation, our firms are market makers, not market takers. What are we talking about here? The market is not waiting for you to take the orders. You must create the market. That means, number one, that you have to create brands that customers want, and that you have to actually provide active sales channels where the largest number of customers can be found to execute on the potential. You cannot execute on the potential unless you inform and persuade your customers to buy a PC, and that happens through your advertising. So the typical AIDA formula that you heard about in your marketing classes, which talks about awareness, interest, desire, and action, which means purchase, is in effect for the simulation as well. If you work with a web marketing tactic, you need to, of course, select the web marketing tactics to encourage customers to visit your websites and to make a purchase. More importantly, what you will find is that markets develop faster when there is a multitude of competitors in the market. Why would that be? Well, if we go by the AIDA formula, awareness, interest, desire, and action, the more firms in the market, the more advertising probably in the same market, which means that the overall awareness level for customers increases. And if awareness level increases, that might spur some interest, and with the interest, it might spur some desire to actually take action and purchase a computer. So there is a trade-off again, the trade-off between markets with multiple competitors, multiple brands, and markets with a single competitor with one or two brands. While being alone by yourself in the market might actually be an advantage for you capturing more of the market share, it might be a disadvantage because your market develops not as fast as the markets where multiple competitors are active. Let's talk about the price. What drives the price setting tactic? Well, of course, the costs. That would be production, marketing, and overhead, which means your human resources. It is also, from your marketing course, you know, partially driven by your profit goals. Of course, then there's also the pricing tactic that is driven by what customers are willing to pay. And last but not least, you have the competitive pricing strategy where you look at what competitors are doing and you position yourself accordingly. All these pricing tactics are playing a role in our simulation. In the beginning, when we are ramping up our production, there is just no way that you can price your computer above your cost. And that's why I said in the beginning, you do not have to expect profits and don't work on trying to make profits. But really try to learn as much as you can from the quarter. Given the fact that you have startup cost, that definitely will exceed your minimal revenues because it's a test market, and therefore your production volumes will be very low. You have high unit costs. If you are pricing above the cost of the unit, you're pricing yourself out of the market. You probably noticed that when you reviewed the customer analysis in your market research. So if you have lots of startup costs and your revenues are really minimal, as you can see in the blue line, it is very clear that you're going to have losses. And that's not a problem because you want to learn. Your profitability comes in at a later quarter when your revenue will exceed your cost structure. What you really want to do is you want to really speed up the acceptance or the adoption rate of microcomputers, because we want to make sure that we're getting out of the introduction into the growth phase as fast as possible. Remember, you're market makers, so anything that you can do to increase adoption of microcomputers and acceptance of your products is helpful for the simulation. And as I said in my response function mini lecture, you need to figure out what is the response function in the market regarding price. Are you having an inelastic or an elastic response function based on the price of your computers versus that of competitors that might actually be in the same market or in the same target segment? You might get some hints on what's going on. However, as you also know from your economics and marketing classes, if you create a differential advantage, you can actually reduce price elasticity and customers will be willing to pay more for your product than that for competitors, or they are not going to be as price sensitive if in the future you increase your price. That differential advantage can be built based on either your brand designs or other parts like your differential better distribution channel or your better advertisement strategy. Now, of course, we do know from economics that markets respond to competitive pricing. That means you're going to have to deal with your competitors and their pricing structure. Usually, a lower price by competitors at similar designs will gain higher market share. Therefore, the demand of your competitor will increase. These information pieces will all be part of your test market. And it's going to be starting to get complex as of Q3, following with Q4, as you will have to really start looking at a cohesive strategy between your brand design, your advertising strategy, your distribution strategy, and your target markets. And then, of course, you have to analyze what your competitors are doing to see how you're stacking up with your strategy.